This is Create the Next from ProCFO Partners, where every week we explore strategies and ideas for financial management and growth to help today's businesses put their financial picture in context.
Welcome back to Create the Next. I'm Chris Mitliff with ProCFO Partners, and I have with me Jeff Franklin from ProCFO Partners. Jeff, it's good to be with you today. And today we're talking about where to go when the bank says no, which is a great topic and a powerful topic. Let's start with a real basic understanding of why would the bank say no? What kind of conversation am I having where I'm looking for something? Is it a loan? Is it a round of investment in some way? And why would they say no that I'm now stuck?
Well, first off, it's great to meet you and great to be here. So I think it's a great question. Banks can say no for various different reasons. They could be something that they don't like about your industry, that has tarnished their view, and they say to stay clear of it. It could be that the company is a new company and doesn't have a very long track record in terms of profitability or performance issues. It could be a slew of those types of reasons. I think sometimes to answer that question, you really need to understand what the company is all about, what they're looking for, and what type of assets that they have that they want to perhaps bank. A traditional bank will be happy to offer a line of credit or an asset-based lending arrangement, but requires some type of assets to support it. So in this day and age right now, especially with COVID and the impact on businesses and the future outlook of some businesses because of the COVID world, banks are reluctant to lend money without any assets being collateralizing the loan.
Is there anything I can do about that then at this point? I mean, our topic today is what to do when the bank says no. So I don't want to spend a lot of time examining this, but if I don't have strong inventory, if I don't have, some of the things that I can't show a lot of profitability, but I know I've got a great idea. Is there anything I can do about that? Or is it time to start to turn my attention as quickly as I can once the bank says no?
Well, there's always a solution for a company. It just depends what market you choose to go on. So a bank, which is traditional borrowings, would typically be at the lowest rates available. Maybe come with a little bit more covenants in terms of requirements for performance-based and collateral. And in the event that the bank says no, you can go a different direction in terms of finding funds. You can go to a private investor and pay a little bit more of an interest. You can go to what's referred to as an angel investor, which is pretty much a private investor who maybe a little bit deeper pockets, wants a larger return. Then you go into the world of a mezzanine lender, which are companies that actually lend at a very high rate of interest, perhaps upper teens. To get you over, they're more short-term solutions because at those rates, it's very difficult to get out of them. And then worst case scenario, you go into the pretty much a private equity sector where you bring in a private equity firm who will infuse cash, look to take stock and equity in your business, and they're going to look to kind of revamp your business and flip it in 3 to 5 years and make money on the deal. So I think there are opportunities if the bank says no. I think a great question is really why did the bank say no? And is it just because one bank says no doesn't mean there's not another bank on the next corner that has a different appetite for some risk. It's all about risk reward.
And you make an interesting point, and I think you're right. And an excellent follow-up question to why did the bank say no is, and maybe it's even a better first question, is why are you seeking funding? As you point out with the mezzanine funding, for instance, if you're an emergency and you just need something short-term, maybe some high-interest thing you're willing to, that's palatable for you, but that certainly isn't a way to run your business. What perspectives do you have? Because I imagine that many of the reasons why a bank would say no is why some other outside funding source might also say no. Your books aren't in order, your reporting isn't there, or you simply don't have the business case where this makes sense. And now you're going to, in order to get the money that you need, you are going to have to go to something that's going to be more high risk. What perspective do you have on how I should be prepared to answer this question of why I need funding, and therefore you should go to this place. I think banks are the safest place, but maybe the most finicky place to get some funding. Tell me your thoughts.
Yeah, well, I think it all goes back to what your business plan is, and to really know what your future needs are, you've got to do projections and forecasts, and it's kind of hard to no one has a crystal ball on their desk, but you want to try and see what you're trying to get to and where you're trying to go, and then a bank. Like, for instance, on a startup company, a bank may not really be interested in a startup company because it's too fresh for them. So there's no historical results. There's no profit stream. So the bank gets a little concerned. It may look like a good deal on paper, but they get a little bit concerned that they're not willing to risk their money for a company that doesn't have a lot of history. So again, it's all about your projections, and a good CFO would take the business model and project out and try and determine what kind of growth the company is going to have, what type of revenue directions it'll go in, and make its cost-cutting assumptions, and then go out and project its cash needs. And that's where it starts.
Do you have perspectives on some of the alternatives today? I'm thinking about micro-lending. I'm thinking about crowdfunding. I'm thinking even, there's the Kickstarter, Indiegogo type of a thing. And for some, especially I think in manufacturing, this can be interesting. It can almost beta test your product for interest. And it's maybe some would argue a low threshold for risk on getting some of that stuff built or created, but it's not for everybody. Do you have some opinions about some of that?
I'm not that familiar with the crowdfunding at the moment. I've just actually finished for one of my clients. We started a search in July for some additional capital, and I've actually tested pretty much the banks, the mezzanines, the private equity. Factors are another source of potential financing. And what I found right now is the credit market, everybody has a lot of money to lend. They're very concerned right now with actually pulling the trigger on some deals because, again, it all goes back to COVID at the moment in terms of, and there's too many companies that are distressed and may not come out of it. So I don't know much about the crowdfunding. I guess it would depend upon the actual business itself. But I will tell you there's a market out there for companies.
You raise an interesting point around timing, which is one of those things that we can't control. You could look as rosy as possible, but if it's a tough time, or as you pointed out early on, if your industry, for instance, restaurants right now, as we have this conversation in the midst of winter 2021, are an example of there's a lot of organizations that are suffering. There's a lot of companies that are trying to go through. How do I position myself so that I can stand among so many others, but maybe in a brighter light or in a better color when I do need to get some funding, whether from an investor or from the bank? What are some things that I could be doing to make sure that I'm putting my best foot forward in these situations?
I think you need to keep your books and records up to date. I think you need to surround yourself with some knowledgeable financial people that'll help you build both your current model and your future model in terms of forecasts, and spend the time to actually develop some financial forecasts that can be submitted to whether it be a bank or a potential investor that will show there's a potential for them not only to get a return of their investment, but to make some money on the deal also.
Do you find that the aspect of not having your books in order, your reporting on point, accurate, up to date, is that a consistent chronic issue for business leaders who know that, or they find themselves in a space where they really need some funding, but this is something that they're lagging in having on point because they haven't sourced it to an expert CFO, or they haven't given it the time and attention that they need to? Is that a common issue?
Yeah, I smile a little bit. I think my experience with entrepreneurs or small business owners is that their concentration is on the sales end of businesses typically, and there's little focus to the back office. In fact, many would probably, if questioned, would say the back office is a necessary evil, and I don't really get value for it. And they shortchange themselves because there's a lot of value, strategic value with the right partner in the back office for you. It's not just somebody who's sitting there with a pencil at the desk with their head down. That you can find an accountant who will do that every day of the week. But what you need is a partner who can do that plus and offer all the options of where the company can go, whether it be, making changes to systems, directional changes, a focus on, on what their clientele should be. In other words, you may have very poor performing clients. Maybe they're very low margin clients. Maybe they're dragging the rest of the operation down. That's what I think a good financial partner could do for these people.
I think it's a really good point, because we can be thinking, just as I mentioned, that, well, your reporting needs to be on point, or you need to have your P&L sorted out. And that is the job that an accountant, can make happen for you, or a bookkeeper can make happen for you. But part of, I think, a healthy banking relationship and the right partners has a lot to do with that strategic guidance. And as you point out, there can be parts and functions of the organization that are, if dysfunctional, you'll never be positioned to make the most of that. That's where that strategic guidance, that financial strategy is really key.
Yeah, there's also, many people look at the banks as being just a lender. I look at it a little bit differently. I look at a bank or a finance company. They are a financial partner for you and your business. So, dealing with them, transparency is very important. If you hit a speed bump, there's nothing wrong with going to them. In fact, they would understand it better to work with you if you explain that you've run into a particular issue at the moment. They would welcome that, okay, rather than trying to hide it from them. So I think that's very important also. But
this idea of knowing how to conduct that relationship, I think, is important too. Sometimes non-financial people don't understand how to have a financial relationship, for instance, with a bank. And that's another advantage of having a strategic advisor in there, a partnership, with a financial executive who's very comfortable having those conversations, is not intimidated or afraid of that kind of transparency.
Yeah, I agree. I mean, it's funny. It's some of the business owners believe that the banks should be knocking their doors down to lend money, and that their company is the best company in the world. I think I think that if you took a step back, you have to realize that the banks could offer a great help to a company. Even covenants, which are sometimes looked upon and frowned upon by business owners, are actually could be very helpful to keep a business owner focused in terms of how his business is running. The covenants are there to put constraints on certain things that the business needs to do, but at the same time to maintain a direction that the business needs to go in to make it profitable. It's very helpful.
Jeff Franklin from ProCFO Partners with some great insights, I think, on the key aspects of a healthy banking relationship and on where to go when the bank says no. I feel like, as always, we've got so much more we can dive in on this. I hope you'll come back and talk to us another day.
I would love to. And I thank you very much for the opportunity. And thank you.
Thanks, Jeff.
Happy New Year, by the way.
Happy New Year. Have a great day.
Thanks for watching. And a special thanks to our subscribers. Consider becoming one today. Visit ProCFOPartners.com for more strategies and ideas for financial management and growth to help you put your business's financial picture in context.